Welcome all, and thank you for joining today's live economic update webinar. My name is Chris Thomas, and I'm the Executive of Commercial Broker and Asset Finance Sales at NAB. Today, we have over 700 of our valued commercial brokers participating in what will be a terrific session, I'm sure. I wanted to start by thanking each of you for taking time out of your businesses and your busy schedules to attend. Importantly, I wanted to thank you also for your valued partnership and working with NAB in supporting Australian business. Without doubt, the economy is showing a very encouraging set of signs of recovery, and the work we do together helping small and medium businesses realise their ambitions cannot be understated. Access to capital remains an ongoing constraint in the eyes of business, and that is why NAB is so excited to partner with you, the trusted advisors to an ever-growing number of business owners who drive our economy. It is again with great pleasure that I am joined today by one of the most prominent voices in financial services when it comes to economic commentary and insight, Alan Oster, NAB's Chief Economist. Alan will discuss the macroeconomic situation and how the banks and government stimuluses are playing a great part to support the economy. He'll also share early thoughts on what an economic recovery might look like beyond this year and into next year and beyond. Just before I do that though, I just want to run through some housekeeping. Kat, would you mind just putting up the housekeeping slide? Thank you. Today's session will run for about 45 minutes. We'll have plenty of time for Q&A. So can I please kindly ask that you use the Q&A function at the bottom of your toolbar in this webinar to post your questions, because we love hearing your questions. They're always really valuable, and we'll put Alan on the spot and see how he goes in answering them. But without further ado, I might introduce the great man, Alan Oster. And Alan, I might hand over to you, and thank you for joining us today. And we'll go from there. Thank you.
Thanks very much, Chris. It's a pleasure to talk to you guys. I'm going to talk, I've got 20 minutes, so I've got more than enough slides. I'm going to jump through a few of them. And what I thought I'd do is try and give you an overview up front about what we're seeing, and also talk more generally about some of the data that we look at when we're trying to get an estimate. So globally, and I should say also, a copy of this pack's available if anyone wants to, and just talk to Chris, and I'm sure he can set it out. So big hits from the virus last year. 2021 looking pretty good in terms of what's happening. The Biden fiscal packages have been massive. So we're now talking, up to 7% growth this year in the US, and that's caused one of the big issues that have they overdone it, and therefore inflation goes up, wages go up. Will the Fed have to move earlier or not? And that's been the debate in the last week or so. It's caused equity markets to go up and down. They're now saying essentially that the economy in the US is fine. They're expecting to essentially get back to the number of jobs that they had before the pandemic by around about September. And that's when they'll start looking at maybe tapering. In other words, not putting your foot to the accelerator flat out in terms of buying bonds. You might start to move it back a little bit. We actually believe with the central banks that the fear that inflation is going to be permanent rather than temporary is probably overdone in markets at present. China, its economy is doing okay. They said they're trying to get 6% growth. They'll get 9% because of the way the system in terms of the growth numbers. Growth in Europe and the UK, and particularly Japan, has had essentially what they call a W recession. In other words, you went down, you came back up, and now in the first quarter of this year, both Europe, the UK, etc., have essentially gone backwards again. So if we look at that, developing world hard hit. So as I said, this big theme about globally inflation is, I think, important, and I'll talk a little bit about that in Australia as well. There's some numbers. I'm not going to go into the details, but if you look down the bottom, 6.3% growth this year, 4.5% next year, and then back to trend by 2023. In terms of Australia, and what I was going to show, if I go back, if you look at the chart. The chart basically shows you the black line is, from the budget point of view, what the better economy is giving to the government, and the grey line is what they're spent. And all you need to see there is essentially whatever the government has been getting out of a better economy, they've been spending it. And remember, that's prior to an election package that will be obviously coming. So what do we expect? Big picture summary. Growth through the course of this year, i.e. December on December, around 4%. You had very strong growth in the snapback to activity in the last 9 months. And so that in year average terms is more like 5. No systemic problems from getting rid of JobKeeper. We would expect growth to be something like 2.5, 2.75, maybe 2.6 in the slide next year, and maybe 2.25 the year after. Means unemployment around 4.7 by late 22. You've seen very strong growth in employment. So the unemployment rate dropped to 5.1. We're expecting the unemployment rate to be there in about September, so it's about 3 months earlier. And so I would expect unemployment to be around 4.5 by the end of 2023. Medium-term outlook really good. And then I think for us, when we look at the economy, we see, and I think this is really important, a change in the drivers of growth. We see consumption slowing back. We see investment, particularly investment in dwellings, anything to do with associated with that, so white goods manufacturing is really strong, and we're seeing really strong growth in plant and equipment investment. So in terms of just some quick visual effects, there's the GDP numbers. We've sort of already passed where we were in December 21. Unemployment, we're already there, put in context, or employment growth, and in terms of unemployment, you're basically already back below where you were when you started. The US has lost about 20 million people, but they've still lost 5 million, I'll put it that way. One of the other things that we look at all the time, and I'll flip over things like currency, etc., and if anyone wants me to ask about it, is we look at our own data significantly. So every electronic transaction that goes across our systems, we can monitor. So later this afternoon, I'll get the data as per last Saturday. And we can do it by postcode. We look at consumption, we look at what's going into business, and I'll show you some of that data as we go forward. But in terms of consumption, this is what we call cash flow. And what it is it looks at every customer's money coming in, money going out. And what you see through time was, after the GFC, you got to about $200 a month cash flow in. Then it sort of eroded away almost to zero. And this big spike of circled there is actually what the government gave essentially to general households. So they spent huge amounts. And in a lot of cases, people were getting more money on JobKeeper, et cetera, than they were when they were working normally. What's interesting to us is what you look at that there, and you see by the time you get to the March, and now we're into June quarter, it's sort of gone back to zero. In other words, people are not getting as much money in as money out, and that can cause grief in terms of people's propensity to continue to consume. So, data insights. So, as I said, a couple of things we look at. Number one, what we used to do, and I'll try and explain this, we used to look at this week versus the same week last year. We can't do that anymore because this time last year, all things were happening. Lots of volatility. So what we do is we try and look at consumption, and we look at red, which is retail, and grey, which is hospitality, and we compare it to the pattern that you saw in 2019. And there is clearly a weekly pattern. So what I'm trying to show you here is, let's say consumption, which is black. Where does it look relative to where we were at the start of the year? And basically it's the same level. But if you look back to the black dotted line there, what you see is that in 2019, this week, the same week, was about 12% up. So what it's saying, and if you look at the data, it's consumption has basically slowed a lot recently. And up until recently, hospitality was coming down, but it was a lot better than what it was in 2019. So generally what we're seeing here is a slowing in consumption. CBD. So not all areas of the economy are great. So we can look at it by postcode. So this is just some illustrations of what we're seeing in CBDs as of March. Now, it may have picked up a little bit more, but if you're looking at the accommodation, sure, Melbourne in black is the worst. But some of the other, and Melbourne's down roughly 50% on where they were in 2019. But the others were still 20% down. Cafes and restaurants outside of Perth, still down. Down the bottom, retailing is actually back to where it was and everywhere, but that's, I think, mainly online. Clubs and pubs, you get a different effect, obviously, if you're in somewhere like Western Australia versus the others. But some of the others aren't great. And so one of the big issues as you look at the CBDs is when will the people all come back? Because until they all come back, if you're a small business or if you're office, etc., you've got an issue because there's people who are going to be spending locally where they live and they're not going to be spending as much in the CBD. And so that, I think, is a big issue. This is a bit of a spaghetti graph, but it shows you what actually happens each week, going back to 2009. And again, there's a pattern. But if I'm looking at the first lockdown, everything went down quickly. There's the Melbourne lockdown. There is the Melbourne lockdown as of 2 weeks ago. The good news is in the second week of the lockdown, even though there's this massive fall in blue in Melbourne, it didn't get worse in the second week. And later this afternoon, I'll get the data for as of Saturday, which will include 2 days of moving out of the lockdown. But also, if you look at this chart, it does typically show you a little bit that Western Australia is not great and Sydney was good, but now starting to deteriorate a bit in the red. This is a sort of bigger picture story. Same sort of concept, except what I'm looking at here is I take 2019 as a year, and then so that's around 100, and you see the normal pattern. And again, the red is this year. And so, yes, in the March quarter, we look pretty good, but look what's happening in the June quarter. And so that's, I think, is really important to understand the consumption side of the economy. And as I went back, if you're not getting as much money in as what you're spending out, that makes people feel a little bit more nervous. Doesn't say that they go backwards. It does say you need other drivers of growth. We've also looked a lot at revenue. Every business bank, so we're trying to build this cash flow for the business bank. And what we basically have seen, so this is the week of the 12th of June. And the dark line is basically where we are now relative to the beginning of the year. And the dotted line is what you saw in the same pattern period in 2019. So generally, we're okay in terms of that. We've developed now cash flow, same concept. What was interesting was up until May, cash flow in business was actually better, even though the revenue wasn't much better. So what was sort of happening here was business was going through and looking at every line of their expenses and cutting it. And part of the story as we go to wages, and we can look at that in a minute, is that people are reluctant at present to pay additional wages, given that they've just done all this cutting. A lot of slides here. What I'd sort of say is we can identify some sectors that are doing better than normal. So they tend to be manufacturing, transport, construction, and agri. Slide that I sort of think is important is the retail slide. And you can see retail, again, it's only basically in May and June that you see this sort of slowdown. And obviously education's got a big issue because the people didn't come in and it's not coming back. So a couple of other quick ones, because I don't want to spend all my time talking. The red line there is essentially, this is out of the business survey, it's capacity utilisation. The red line is versus long run trend, and the blue line is the actual read. But basically what this chart shows you is last year, the economy lost about 9% of its capacity. And then it recovered really quickly. And as of now, as of May, and we'll get another reading in June in a week or so's time, it's about 4% above capacity. So what you've seen is a really big change in terms of the economy. Everything in our survey, be it confidence, forward orders, actual outcomes, is way above what it was over the long run of this history of the survey. So the momentum in the economy is massive. Now, one area, where is it? Well, manufacturing at present. Retail in the business survey is still strong. I sort of worry about that. So our retail data internal data is a lot weaker, particularly in the last month or so, than what this data is showing. And generally everything's getting better, is sort of the bottom line. And like what we've seen elsewhere in our data, it's probably Perth and Queensland are the strongest at this stage, but everything's recovering, is basically the bottom line. Inflation. This is the sort of story that people worry about. Markets particularly worried that is inflation going to pick up a lot quicker than the Reserve Bank thinks, and therefore they're going to have to increase rates faster than they think. The Reserve Bank has a view that, yes, there's some temporary increases in wages, and we see it in our data in construction and manufacturing. We don't see it generally elsewhere. But you also, in headline inflation, so red is the headline and blue is what the Reserve Bank's targeting. And they're trying to get 2 to 3%. So why does you get this massive spike? In a month's time, you're going to get, people tell you inflation is 3.5. It is, because this time last year, childcare was free. Now it's not. So you get a sort of big spike down, big spike up in the 12-month two growth. But if you use the trim mean, which is what the Reserve Bank does, is you don't count the bottom 10%, you do count the top 10%, or you don't count the top 10, and you average the rest. Outside of special areas such as cost of construction, some supply side shortages, you need wages to be growing strongly to increase core inflation. And for us, if you think productivity is roughly 1%, it means you need wages growth of 3.5 for the Reserve Bank to move. That's why the Reserve Bank's still selling the story that they're not increasing rates until 2024. The real question for you guys is, when do you think wages generally is going to be above 3? And I think it's going to be a long time away. So I'll talk a little bit more about it in a minute. In terms of house prices, I know a lot of commercial brokers here rather than house prices. This is a bit of a history. There's still, if you look at, you see really sharp accelerations in Sydney relative to long run, also Adelaide and Brisbane. Melbourne's sort of roughly where it was, and Perth, unfortunately, still below where they were in 2017. This is, if you annualize the last 6 months, give you a feel of the dynamics. And you can see Sydney's up above 30%, Australia's up around 20%. And if you think of about everybody's up, why did that happen? Because 12 months ago, we were really worried. Population growth. It doesn't look like now population is going to be reopened to the world until mid next year. So you got the slowest growth in 100 years for population. That's normally important, and it does have big negative impacts on areas like CBD Melbourne, and it's have impacts also in some areas, particularly where you're exposed. Unemployment, we were worried it's going to go to 12%, it's now 5.1%. So that's a different issue. Rents were going down there, now starting to go back up a little bit. The ones that I think are really important in terms of house prices, changing location of people's employment in terms of where they live. So if you've got Zoom and you've got internet, you're quite happy to work. If you're in Melbourne, you can be in Geelong, you can be in Ballarat, Bendigo. If you're in Sydney, you can be Blue Mountains. In Brisbane, you can be basically down in Noosa or Gold Coast or whatever. And what's interesting is in Australia, the capital cities, house prices are increasing faster than the capital city house prices. The other one is interest rates are so low, and the Reserve Bank's telling everybody they're going to stay low for a really long time. And that means, in a lot of cases, we can actually see situations where if you buy a house and mortgage it, the cost of doing that is actually less than renting that same property. So the driver of a lot of the growth has actually been first-time owners and not a lot of investors, although it's starting to pick up, and not very many foreigners. So in credit numbers, what we see is not a big increase in credit. So people say, oh, this is a housing boom and it's all associated with credit. Well, housing, owner-occupied credit might be 7% this year maximum. Investor might be 2%. So overall, you're probably 5 to 6% housing credit. It's not essentially that it's been borrowed. In terms of for what it's worth, if you look on the left-hand side, house prices, they're roughly 20% up, 15 to 20% up this year, and more like 5 to 6% up the following year. Down the bottom, units, we don't see units going up a lot, and we are worried about CBD, particularly office and anything to do with retail in the CBD. If you're looking at industrial, that's a different story because people need places to store their online. This is a chart I'll be fairly quick because I've got a couple of minutes and then I'm finished. Blue is private domain. Red is public domain. And that chart goes back to the 80s. You've never seen a fall and then the rise that we've currently got in the economy. So if we sort of look at our growth forecast at present, the red is the quarterly numbers we're expecting. The black is the 12 months too. So you went down 6% at the bottom and you're up 8% or more in the future. And so we see that as a massive recovery. And can I say, as a big picture story, Australia has handled the virus very well. And we haven't had the scarring that a lot of other countries had. So Australia in the medium term, I think, is going to look really good. It's a good place to live, good place to invest and to employ. And so I think in the medium term, Australia will do well. Unemployment, well, we've got it down a little bit below 4.5% in the out year. And what's important is you need it somewhere around 4 to 4.5% to get wage pressures going. We've done some internal work for the Reserve Bank, and it's basically saying, as I said before, at this stage, it's temporary. It's in some sectors, but it's not broad-based. And the wages growth is currently 1.5 sort of in terms of growth. And it needs to get to 3. So final slide about rates. RBA's out there telling everybody late, or not till 2024. I think it could possibly come a bit quicker, but I'm not in the 2022 camp, which is the markets sort of suddenly moved to. I think it's probably late 23, but when they go, they'll go quickly. And I could see rate increases of, you go from 0.1 to 2% within 12 to 18 months. You will see in the next meeting of the Reserve Bank in July, a couple of decisions. Decision number 1 is, what do they do to buying bonds? I think they'll taper it. In other words, they won't buy as many bonds in the next 6 months as they did previously. They've been buying $100 billion every 6 months. So they'll either say, well, I'll do 100 billion over 12 months, or I'll do 75 for the next 12, or some sort of flexible package. The other thing is yield curve control. They're trying, when they set this all up, it was April 24 in 3 years' time. So they were buying the April 24 bond. That basically says you don't expect to increase rates and have inflation issues at all in 24. And so their question is, do they roll it into September 24? And I don't think they will. So to me, I think you're going to have a long time. I think the market's getting too pessimistic about rate rises in 2022. I think it's a long way away. Wages is critical. And the Reserve Bank has also changed their context a little bit. They've basically been saying, I'm an inflation targeting central bank. And I'll wait until I see the inflation numbers now because I haven't hit my target for a long year. So I'm now going to stop, and I think we go back to Chris and questions.
Thanks, Alan. Great. Probably I might open the batting if you like.
Yeah.
What do you think these mini lockdowns, or what impact do you think these mini lockdowns that we're having in Melbourne and then potentially in Sydney will have on the recovery? Because we seem to be living obviously with this virus.
Yeah.
For some.
Well, what you see is temporarily you see roughly a 10% fall in consumption. And so if I'm looking at what did the Melbourne lockdown do, it's been around for a couple of weeks. I think it'll probably take 1% off GDP from Victoria. And I think that would take 0.2, 0.3 off Australian GDP. It's not as deadly as what people think, because what Australians typically happen is that for every foreigner who comes here, there's 3 Australians who normally go overseas. So what you get is a switch in the growth momentum. So, I can't go to Queensland, or I can now. So I booked my holiday in far north Queensland in July, mid-July. So I'm very pleased when they changed the rules. But the alternative would be if I couldn't go. So someone in Sydney, for example, can't go to the country anymore. Maybe I'll just spend it in the shops. And so that sort of changes. I think in some sectors it will cause grief. So, for example, if they lock down Sydney for a while, that will cause loss of people who were previously coming there. But then the people that are living there might just spend a little bit more somewhere else. So I don't think it is that big, but the problem is you just don't know what it does to confidence. And you also don't know. So I'm down in Melbourne and Brighton. There's a couple of shops I did not expect to see go bust. And the heading out the front is, I'm sorry, we just can't reopen. This is just really good. We'll try and do it in a couple of weeks' time. But it might be the straw that breaks the camel's back.
Yeah. It's definitely something that everyone's watching closely. Do you think that the rate of vaccinations becomes a future economic indicator, or?
Well, I think it's important because the faster you get the vaccinations, the less you have to worry about this sort of stuff. And also the less you have to worry about, well, also there's more people coming. So you will ease the problems that, say, the pickers are having, because there's no people coming, kids to pick the fruit. You'll ease some of the problems also in terms of I can't get suitable labour. Of course, there's less than, the growth in population is what, 0.5, whereas normally it's 1.5. So there's less people to choose from. And so and therefore maybe I have to increase wages a bit more, I'm not sure. But it would be good, having successfully combated the virus for ages, to get the bloody vaccine in. I think they got caught by picking the wrong one.
Yeah. Okay. Now, thank you, everyone. The questions are starting to come through. So, Alan, I might just look up at my other screen and take some of the questions. So the first one, while the RBA may not raise rates, will banks increase rates outside of this?
I think the banks have already started to increase rates outside of this, and that is in the fixed range. Why? Basically, what's happened is after 3 years, Reserve Bank saying, guys, I know what I know you think you're wrong, but I'm not. And therefore, I am keeping the 3-year cost of funds down to 0.1. Once you get beyond 3 years, then you see this essentially effect coming out of the globe that says, I think these central banks are wrong. And therefore, the 5-year rates going up a lot higher. I doubt very much that the banks will actually increase the variable. That I think would, we're not well loved anyway, and I think that would be a particularly nasty political spin if we did. So I think it's the question of when does the Reserve Bank move? And to me, forget about inflation and just look at the wages, because that's when they're going to respond. And I find it really struggle, particularly if next year they're reopening. Let's say the vaccines have all been put in the reopening, then you've got more people coming. So I think the market, I'm still on the central bank side, if I put it that way. But I wouldn't rule out late 23, and the first one might be 40 points, i.e. you get back to a half. There's no point mucking. I do think they need to move up to something like 2%, something more like normal, fairly quickly.
Yeah, certainly a lot of commentary in the market. Captains of industry challenging RBA thinking, but one to watch. We've got some great questions coming through, so I'll just take this one. Present it for you, Alan. In your view, how essential was the bond buying program, the TTF, for the local credit markets? Seems that banks borrowed cheap, lent cheap, but the margin was fair. Spreads didn't indicate too much fear, risk, or potential of a credit crunch.
In terms of liquidity and that sort of stuff, it was important. Could I just say something controversial? In the current environment, monetary policy almost doesn't matter. What really matters is fiscal policy. And the government was really good at getting that and keeping the economy alive. And so, but yeah, the Reserve Bank was trying to do everything it possibly could. And yeah, banks did access this cheap fund. The government sort of insured some of the credit risk as well. And I think the banks operated as a shock absorber, which is what they're supposed to do. So I think, yeah, monetary policy did very well in terms of keeping those interest rates low, keeping the market under control. And I think they'll continue to do that.
Sure. Another good one. With all the housing prices increasing so fast with low rates and government stimulus, etc., what are the chances of prices correcting or crashing in the next few years?
Next couple of years, I don't think it's likely because it's not financed on debt. I worry that maybe 24, 25, when you see a big increase in rates, and I expect that will happen, that might shake a few things out. And so for me, I would not be worried about good property in the next 2 years or so. I'd sort of feel a little bit more nervous about 24, 25. And the only good thing you can sort of say is do remember, and again, you have to be careful because no bank loses money on average. Because on average, the consumer in variable home loans has 3 years, 3.5 years worth of advance payments that they can make. That doesn't mean, however, that if you've just bought at the top of the market, whenever that is, and you've lost your job, that you're going to be anything other than in deep trouble. So I don't see it as a systemic issue. But I do worry a little bit a few years out, but that's a long way out. And the government's still got lots of ammunition.
Yeah, probably a related question then. What is the likelihood of APRA tightening the lending standards to curb, I guess, any potential risks?
Just at present, what's interesting is macroprudential tools normally are fired at investors. And the investors' growth is like 2% up. And it's only, most of that's occurred in the last month or so. So it's not really the tool that you should use. I think if house prices kept up and investors kicked back in, then the central bank would basically, or APRA would come in. And I think where they would come would be in the area of deposits you've got to have. So you might say, you might need a 50% deposit if you're an investor, or 25% deposit if you're an owner-occupier, or what they call debt ratios, which are basically, well, I've got 100 grand in income, therefore I can borrow 500, but I can't borrow 600. So they would be the things to do. But just at present, RBA doesn't want to change rates. I think they would hope that gravity eventually works and the house prices start to slow. Must admit, we haven't seen a lot of signs of that, but we have not seen a lot of investors either. So I think they're sitting and watching for a while yet.
Yeah, sure. And everyone, great questions. And I just encourage you, if you want to ask a question, please just use the Q&A toolbar. One, just while we wait for some more to maybe come through, I'm always interested in your views on, labour capacity, but maybe particularly, what do you think 2023-24, what it looks like for new Australians coming into the country, the opening of international borders and our inflow of new immigrants?
I think it'll be quite an attractive proposition because the unemployment rate's going to be, could even have a 3 in front of it, but I think it's more likely to be very low 4s. I think you'll see the economy is basically travelling pretty well. You would see obviously issues associated with China, but I think what you're also seeing is the Australian governments and others trying to say, well, you don't, I mean, one of the lessons, I think I've said this to you before, Chris, one of the lessons is don't put all your eggs in one basket on the supply chain. I've certainly said this before to a number of people, if the Chinese could figure out how to make steel without iron ore, we'd be in deep trouble. But I think if we diversify, and a lot of countries see Australia and they say, well, your fiscal position is really good. The economy didn't get hurt like everybody else, or as much as everybody else. And you're still attached to, Asia, Japan, Indonesia, and, places like the UK want to have a free trade agreement with us. So I think it'll look good, is basically the bottom line. And I think there'll be a lot of people very interested in coming in.
Yeah. I'm interested also just in how sustainable you think that this move back towards local manufacturing, local supply chain management is. Is this actually a moment where we're fundamentally changing for the better towards really starting to manufacture and make things here?
I think it's a positive change. I mean, in the past, everyone just said, I'll just take the cheapest. And that wasn't great. Some areas like medical manufacturing, I think we're really good at. Areas like agriculture, we're really good at. I think anything to do with the internet and digital economy, we're good, and we should continue to build that ourselves. Because otherwise you end up with the sort of situation we had last year, and to some extent what we've got now, where supply chain problems have been an issue. The one I always quote all the time, and you've heard it before, is the cost of a brick in Sydney, 30 cents last year, can't buy them under $4 today. So, you need to have that sort of ability. And I think supply chain I think that's an issue that China's going to have to look at, because globally, a lot less people are prepared to just have the reliance purely on China providing stuff. So I think diversification of trend is something we need to do, and we do need to build things that are good. And I think I've said to a number of people in the past, it's not, well, you can say it probably now, Australia's cost of living is about the same as Germany's. And the Germans somehow still managed to build cars. And, the old throwaway line was, yeah, but they build Mercedes and we build Holtons. But so you need to be good at what you produce. And so that I think is important.
Yeah, great. Probably related to the cost of bricks. Really good question. Yeah. Is our economy over-reliant on the construction industry in terms of jobs, etc.? And maybe an extension of that, while you've got the mic, is what your view on infrastructure projects driven by government and what that looks like in the next couple of years?
In terms of construction, answer no, they are not over-reliant. In fact, construction and manufacturing about 1 million. Health and associated care is like 1.8, 1.9 million jobs. Where construction is good is it has a lot of what economists call multipliers. In other words, you get that going faster, it produces a lot more jobs elsewhere. It's probably the bottom line. So I don't think we're over-reliant on that. And you do need to remember that the construction cycle in the old days in Federal Treasury, we used to call it a sine curve, up, down, up, down, up, down. On infrastructure, I actually like the idea of building more infrastructure. The cost of infrastructure at present is, even now, a 10-year bond is less than 2%. And so in real terms, the cost is nothing. I would like to make sure that when they spend it on things we need and do produce productivity offsets, rather than spending on areas that just happen to be the local marginal seat. But we can afford that. And if we could sort of build and increase our capacity, we want to be a smarter country, basically, is the bottom line. I think infrastructure, provided that it's productivity enhancing, is really good. Because we can afford it and it doesn't cost much at present either.
Yeah. Just touching back on your thoughts around the working from home phenomenon, what ongoing impact do you see that having on commercial real estate and values in market?
Yeah, now you're going to make me depressed. Look, we do a survey, and basically of the property developers that we did, about 400 of them, we asked them a question that said, how much, when this is all finished, how much will people come back to the CBD? Nobody said more than 80%. Now, okay, you've got to have more people around, and you have the sort of distances, etc. So each building is now not going to be able to occupy as much as what it used to. But outside of A grade, I've got to sort of think that all our surveys are saying it's not getting a lot better. It's saying A grade's fine, B grade, C grade, well, if the rents are going down, and they are, then the value of the property is going down. And so that sort of makes me a little bit more nervous. It's very different to say out in the suburbs somewhere where people are living and working, or even in the bush where people are living and working. And as I said before, industrial is much better.
Yeah.
But we don't see office and retail in the CBD as anything other than a very difficult issue as we go forward.
Okay, well, Alan, I think we might wrap because we've got 2 minutes to go. Is there any final words from you before I just make some closing comments?
Oh, look, I just go back to this theme that Australia has done very well on the virus, has not had the sort of problems that other countries have had in terms of deep scaling. And I think, provided that we can get some productivity enhancing buildings and reforms, etc. And I must say, so far, all the government's done is kept the economy afloat. I'd like them to do a bit smarter. And maybe if I'm a pessimist or if I'm an optimist, that's political, and therefore it's going to be in the election cycle. But I do think Australia's outlook is very good. And so I'm an optimist. I'm very pleased I'm still living in Australia. So Chris, back to you.
Well said. No, you are the great optimist, Alan. So thank you again for spending time with us today. And I think it's been a terrific session. I hope all of our value brokers who are able to join us today get some great takeaways and insights that they can share with their clients. On behalf of NAB, I want to say thank you to all of our brokers again for joining today and your ongoing partnership. As the bank with one of the widest lending propositions in the market, we're proud to partner with you and create those innovative solutions that really help Australian business move forward. So have a great day, everyone. Thanks for coming along again. We'll make sure we circulate a copy of today's presentation, and have a great day, everyone. Thank you.